So how much money is actually needed to purchase a secondary home? In today's video, I'm going to be giving you some practical knowledge packed with tons of value, explaining the difference between a secondary home, an investment home, and how lenders actually define the risks between the two. And by the end of this video, not only will you understand the difference, but you'll be able to make smarter and wiser financial decisions when it comes time to buying your next home. Remember, if you get any value from this video, be sure to like, comment, and subscribe, and let's get started. So before we get going, understand that this video is probably going to be pretty long because it's packed with a ton of value, but I promise you, if you stick around and you absorb the knowledge, it's gonna be worth your time. And on top of that, I'm going to leave this Excel spreadsheet down below if you wanna print it off for yourself. Another thing I need to preference here is I live in the state of Michigan, so depending on who's plugging into this, things may be a little bit different where you're at. So what you can do is talk to some lenders and some local real estate agents to make sure all this information is applicable to where you're at. So the first thing that we need to establish is that it's a secondary home, okay? Vacation or personal use. It can't be an investment property. So what this means is that you'll be living in the property part-time, not renting it. Very, very important. You're not renting it, you're living in it part-time. It needs to be at least 50 miles away from your primary home. And you'll be occupying it seasonally or on the weekends. So you're probably wondering, what's the purpose of the 50-mile rule? Let's break this down. Lenders and mortgage investors like Fannie Mae want to prevent buyers from claiming an investment property as a second home just to get lower interest rates and easier loan terms. Okay, so you need to think about this from a risk standpoint. When people buy a house, a lot of people, when they're buying their primary house, they want to find and target the lowest interest rate. And the way investors and bankers look at this is, yes, we want to offer lower interest rates because we know that more than likely they're not going to default on their note. They're going to pay it because they need a place to live. When it comes to a secondary home, things are a little bit different. They look for clear physical and functional separation between your primary home and your second home. And if the second property is within about 50 miles of your main home, a lender may assume you could easily commute there, so it's probably not a true vacation or secondary residence. Fannie Mae's rules don't explicitly say 50 miles. Let's be clear on that. But most lenders interpret this way. Every lender's different. So again, depending on where you're at, this may be different than where I'm at here in the state of Michigan. A second home must be a reasonable distance from the borrower's principal residence. It must also be available for the borrower's exclusive use and not rented full-time, suitable for year-round occupancy, and not subject, here's key, it's not subject to a timeshare or a rental agreement. And if you want more information on this, you can just go to this source right here and I'll give you more of a breakdown on how this works. Because reasonable distance is very vague, underwriters and banks typically use the 50-mile radius, but some may say it's 48 miles and some may say it's 51 miles. Everyone's benchmark is a little bit different, but just so you know, if you're looking to buy one, 50 miles is going to be typically the benchmark. Typical requirements for a secondary home. Down payment must be 10% for conventional loans. And now you're probably asking again, well, why 10%? Why is that 10% so important? It's a higher risk loan. Conventional loans now are 5%. FHA loans are 3.5%. VA and rural development, they're 0%. So there's not a lot of skin in the game that needs to be put down. When you're buying a secondary home, you're not living in there full time. Think about it from this standpoint. A second home is riskier than a primary residence. If someone loses their job or runs into financial trouble, which home do you think they're going to drop first? The secondary home that they're going to on the weekends to enjoy their getaway from their job, or the home that they're living in full time? Okay? Of course, we know it's a secondary home. And because of that, it's more risky. So lenders want the borrower to have what we call more skin in the game in the real estate world. A bigger down payment makes it less likely someone will walk away. That's why the minimum is 10% instead of 3 to 5%. Does that make sense? If this doesn't make sense, leave me a comment and I'll try and find a way to make another video to explain it more thoroughly, but just think of risk. If you're not paying cash for it, you're not the bank, right? When you pay cash for it, essentially you are now the bank, because if you want to rent it out, right, you control the terms, but when you're borrowing money from a lender, it's their rules. And they're all about defining what the risk parameters are. Additionally, because they're conventional loans, they're not backed by the government. Remember, unlike FHA, VA, or USDA loans, conventional second home loans have no government backing. So if the borrower defaults, the lender, the investor, the private money they're taking the risk. They can't just go out there and print money like the government. It's not how that works. So to protect themselves, they tighten the loan to value requirements, require stronger credit, usually 700, and require higher reserves, often 2 to 6 months of the payments in the bank. They want to make sure that you're financially stable to be able to do this. So that 10% minimum helps offset some of this exposure. Now, understand your interest rate is going to be about 0.25% to 0.5% higher than your primary residence, and again, because it's more risky. Remember, FHA, VA, and USDA loans, they're backed by the federal government, and they have what we call occupancy requirements. And so because there's occupancy requirements, meaning the borrower must live in that property for a certain period of time. Let's break each one of these down quickly. So under a FHA loan, which is backed by the Federal Housing Administration, the occupancy rule for this mortgage is that the borrower must occupy this as a primary residence for at least the last 12 months. Under a VA loan, which is under the Department of Veteran Affairs, the borrower must intend to occupy this property as their primary home. And under the USDA loans, U.S. Department of Agriculture, this is only for owner-occupied, rural primary homes. So now you can start to understand why you can't use a secondary home under any of these loans, because they're not going to allow it, because you're only going to be there part-time, not permanently. Make sense? Let's give an example. If the home is a $300,000 home, the minimum down payment at 10% is $30,000. Remember, better rates or easier underwriting come when you put more down. So a lot of people in this situation, they're gonna put 20% down because the rates are gonna be better. Why? Because they're putting more money down, they have more skin in the game. So just remember, whatever number that you're looking at, just times it by 10%, and that's the amount that you're gonna have to put down for your down payment. Now, I know not everyone's looking to buy a secondary home just for vacation and personal use. Some of you are actually looking to buy a secondary home as an investment. So let's break down the meaning behind investment. You're gonna rent it out. That's the whole goal. So if your plan is to rent it as a rental, Airbnb, tenant property, lenders treat it as an investment loan, not a second home. So there is a difference between a second home and an investment home. And the biggest difference is the risk associated with it. So the typical requirements for an investment property, not a second home, the down payment is anywhere from 15 to 25%, but most banks require 20%. Higher interest rates, 0.75 or 1% higher than a primary home, and reserves, principal, interest, taxes, and insurance of at least 6 months are often required. So let's talk about this 15 to 20% and why this is so important. Both agencies that buy conventional loans have very strict investment property criteria. So for an investment property, the minimum borrower down payment is 15% for a 1-unit property here in the state of Michigan, and 25% for 2 to 4 unit properties. Now, if you want to know more about this information, just reference this code here and you can look it up and you can study it for yourself. Again, 1 rental unit, 15% down, 2 to 4, minimum of 25% down. And this is to ensure that investors have substantial equity and aren't speculating with borrowed money. And lenders know that the rent's not guaranteed. So if you go into this type of investment thinking that you're going to occupy the property 100% of the time, your thinking is flawed, and you need to understand that's not reality, okay? That's not how it works. Even a good tenant can leave suddenly, or the property can sit vacant for months. Anyone that's had a rental property, they know this. And because rental income isn't guaranteed, lenders will only account for 75% of the projected rent as usable, and the rest is used for vacancy and a maintenance buffer. That partial income equals higher risk, and because higher risk, they want a higher down payment. So remember, historically proven that the more money someone puts down, the lower default on the borrower. And again, this is all based on statistics and what's happened in the past. But think about this. Say that you're an investor and you're buying a property, and you put 10% down on, say, a $300,000 home. That 10% is $30,000. It's still a lot of money, don't get me wrong. But now let's flip the coin and say that you're required to put 20 to 25% on $300,000, which is $60,000 to $75,000. How much more emotionally are you now attached to this deal than, say, the $30,000? And again, they're both a lot of money, I get that. By forcing a higher down payment, lenders dramatically lower their risk, and they know this. So let's talk about this reserves and how this is actually calculated. So you always want to add taxes, insurance to your equation. Now again, I'm just reflecting here on the state of Michigan, but property taxes are typically about 1.4% of value per year on the property. So if you take $300,000 times it by 0.25%, that gives you $4,200 a year, and just divide it by 12 months. So that's $350 a month that we're going to be putting away for taxes. Roughly. Just like taxes, insurance is always fluctuating, but typically it's about $100 to $120 a month. So let's figure out what this is. Let's add up all these numbers now to give us a rough idea of what our monthly payment is going to be. Our first number is principal and interest, which is $1,570, plus your taxes for the year, plus your insurance. You add all these together, it gives you roughly $2,040 on a $300,000 investment. So let's run through an example. So again, for a $300,000 home with 20% down, which is $60,000, your loan amount now is going to be $240,000. And at a market 6.8% interest, and I'm just speaking now what the current interest rates are. Again, your monthly payment is $1,570, principal and interest. So if you're one of those math people that like to run the numbers yourself, I put this together for you so you can have the formula and you can do the math yourself if you so choose to. But this is a step-by-step breakdown. So the first thing is to determine your loan amount, okay? And again, we're using the $300,000 scenario, 20% down, which gives you the $240. And then what you want to do is you want to use the standard mortgage payment formula, which is below, which is your monthly principal and interest for a fixed rate loan. And this is the formula. So where M is, just put your monthly payment, your principal and interest. Where the P is, put the loan amount. Where the R is, you want to put your monthly interest rate. So take the current interest rate, you divide it by 12 months. That gives you your monthly interest rate. That's where you put that number. And then where N is, the number of payments, take your 30 years times 12, and that gives you your number of months. And this down here is the actual formula, what it looks like when I plug the numbers in that I've used. Hopefully this provided some good information for you. I really put a lot of thought into this. If it did, be sure to leave me a like. If you have any questions, put that down below and I'll be sure to answer those. And as always, subscribe. And listen, before you go, if you want to know how to save money to actually buy a house here in 2025, check out this video. I'll give you some really basic practical tips that I know will help you out. Thanks again for stopping by, and I look forward to seeing you on a future video. Take care.